Good evening, and welcome to Friday Macro Analysis. This week, markets were hit by a sharp and broad-based shock. A strong U.S. jobs report did not calm investors. Instead, it triggered a violent repricing across nearly every major asset class. Stocks fell sharply. Bonds sold off. Oil, copper, and precious metals all moved lower. The dollar, however, strengthened. At first glance, that might look like a simple risk-off move, but the deeper story is more important. What we saw was a system-wide liquidation event. This was not just about one disappointing sector or one weak narrative. It was about a portfolio-level shock. When one crowded market breaks, the pressure spreads. The key mechanism here is VAR, or value at risk. Large institutions do not just own assets. They run risk budgets. If volatility spikes too fast, their models force them to cut exposure. That is exactly what happened here. Semiconductors had become one of the most crowded trades in the market. When that sector dropped more than 10% in a single session, risk systems likely triggered broad deleveraging. And once that process starts, it does not care much about fundamentals. It does not ask whether a stock is cheap. It asks whether the portfolio is still inside risk limits. So institutions sell what they can, not what they want. That means even good assets can get hit when the system is under stress. The selling becomes mechanical. And that mechanical selling can spill into every corner of the market. This is why the move felt so violent. It was not just a correction. It was a liquidity event amplified by risk management. The bond market gave us another important clue. After the jobs report, both short-term and long-term yields moved higher. But short-term yields moved faster. That is called bear flattening. It matters because it tells us what the market now fears most. The market is no longer just worried about inflation in general. It is worried that the Federal Reserve may need to keep policy tighter for longer, or even hike again sooner than expected. The 2-year yield is especially sensitive to that view. When the 2-year rises faster than the 10-year, the curve flattens. That is the market pricing in more immediate policy pressure. In other words, the market is saying that the easy part of the disinflation story may be over. The next phase may be harder. This is a major shift from the soft landing narrative. It suggests that investors are starting to price in a more restrictive financial environment. For years, many investors expected one of two outcomes. Either the economy would slow into a hard landing, or it would move smoothly into a soft landing. But the current setup supports a different view. No landing may actually be the worst outcome. Why? Because if the economy stays too strong while interest rates remain high, the Fed has no reason to ease. And if the economy stays strong enough to keep consumption and employment firm, then inflation pressure can remain sticky. That means nominal growth stays hot, and hot nominal growth forces financial conditions to stay tight. This is the core of the no landing is bad thesis. The problem is not weakness. The problem is excessive strength in an environment where liquidity is already constrained. In that kind of system, markets can get trapped. Growth is too strong for the Fed to cut, but not strong enough to justify unlimited risk appetite. That is why strong data can become bad news. The market response also tells us something about positioning. For a long time, investors have been conditioned to buy the dip in semiconductors and AI-related names. That has worked repeatedly since 2023. But this time, the scale of the move matters. Even after the correction, many of these stocks are still expensive in absolute terms. The narrative is still powerful, but the valuation cushion is not very large. So some investors may still see the pullback as a buying opportunity. But from a macro point of view, this is not obviously a cheap entry point. It is more like a reset inside an already stretched trade. By contrast, energy looks very different. Energy has been under-owned for years. It has lagged for a long period. And in a market shock like this, it can be sold alongside everything else even when the fundamentals are strong. That creates opportunity. If geopolitical risk remains elevated, especially around supply routes such as the Hormuz Strait, then energy is not just a trade. It is a direct supply risk hedge. That is why this sector may deserve more attention than it has received. Precious metals matter too. If the market enters a more severe shock phase, the Federal Reserve may eventually be forced into a more dovish tone, not because inflation is solved, but because financial conditions are tightening too hard. In that environment, gold can become one of the first assets to react. It is a monetary hedge. It responds to confidence in the currency, the policy regime, and the stability of the system. But there is an important distinction. A dovish Fed does not automatically mean stocks recover right away. That is a mistake many investors make. If the economy is already overheating, then a policy shift may come too late to stop equity damage. Equities depend on earnings growth. If confidence in growth is breaking down, lower rates alone may not be enough to rescue prices. That means gold may respond earlier than stocks, and stocks may continue to struggle even after the Fed changes tone. Now let us step back and look at the bigger structural problem. We are entering what you can call the spending era. The U.S. government is still financing large deficits through Treasury issuance. At the same time, large AI companies are demanding enormous capital expenditure, and major IPOs are pulling even more cash out of the system. This matters because global liquidity is not infinite. There is only so much cash in the market at any one time. If the government is absorbing capital through debt issuance, and if large firms are absorbing capital through equity issuance and debt financing, then the rest of the market has less to work with. That creates a direct competition for savings. And once investors start reallocating into new issuance, they often have to pull money out of existing assets. That is how the crowding starts. That is how a bubble begins to lose oxygen. This is the key macro point. Liquidity is not just about central bank policy. It is also about how much capital is being demanded by the government, by corporations, and by investors at the same time. If all of them want the same pool of money, the system tightens. This is why the current environment has bubble-like characteristics. Prices have gone up, but the reason prices went up was not only earnings. It was also abundant liquidity, low rates, and heavy speculative positioning. Now that liquidity is becoming more contested, the market is vulnerable. Mega-cap AI names still have strong stories, but the market may no longer reward story alone. It may now demand actual cash flow, actual execution, and actual capital discipline. That is what happens late in a cycle. The market stops paying for everything. It becomes more selective. And when it becomes more selective, the weakest assumptions are exposed first. So what should we watch next? First, we should watch whether the job strength continues to push the front end of the curve higher. Second, we should watch whether VAR-driven liquidation spreads beyond semiconductors. Third, we should watch whether energy and gold continue to attract capital as defensive macro hedges. And fourth, we should watch whether the spending era begins to pull too much cash out of the system. That is the real macro story. This is no longer just a debate about one stock, one sector, or one rate decision. It is about a system that may be moving from abundant liquidity into capital competition. And that is often where the biggest market shifts begin.